Well, in this mix of global macro concerns and markets, oil fell to a 2-month low earlier. Prices are
tumbling to a level we have not seen in 12 years, folks. Oil prices are falling every day. Part of the reason we're seeing this dramatic fall in stocks, oil prices also falling. Welcome back. Oil prices at the lowest level of the year.
We're going to go a lot lower, but then we're going to go a lot higher because after the bust comes the boom.
This is a once-in-a-lifetime buying opportunity for energy coming up.
I've never seen an opportunity like we are seeing today. We probably never will again in our lifetime.
Doubling down on the business by starting a new oil venture.
One Chinese company is spending $1.3 billion to buy giant oil fields in Texas.
This short video is all about how to invest in assets that make residual, long-term income coming month after month. Something that is hassle-free, hands-off, asset-backed, and has at least 30 to 40 years of income coupled with a great exit clause. This type of investment that pays the bills without you lifting a finger and allowing you the freedom to do what's important day to day. So I want to just tell you very quickly a story of how I became a Texas oil millionaire without knowing a thing about oil and only investing $140,000 just once. I want you to imagine for a second the greatest real estate deal you've ever seen anywhere on the planet. And if you don't invest in real estate, just follow along for one quick minute and it's going to make a lot more sense this way. So, how would it sound if I offer you a brand new 4-bedroom house for $140,000 that already has a tenant in place who pays on time every single month and they signed a 35-year tenant agreement locked in place? In other words, you're pretty much certain that you'll get this income uninterrupted for at least 35 years. And you also have a guarantee that the tenants will never damage anything, so you have zero ongoing maintenance costs. In fact, the investment is completely hands-off, and more importantly, it's hassle-free. And to top it all off, they agree to pay a whopping $5,000 a month in rent, which is a 32% ROI, in contrast to the average real estate deal that'll yield you around 7% ROI. So 32% ROI is a killer deal, especially since you have a 35-year agreement in place. Now, here's where the deal gets really interesting. The house is in a massive upswing growth corridor, and every expert on the planet is saying the house will triple in price in the next 5 years. As part of the agreement with the tenants, they agree that when the property does increase in price, so will the rent they pay you. So the 32% ROI is minimum. When it triples in price, your ROI will triple too, and you'll be close to 100%. It's starting to sound way too good to be true, right? But let's say there's a real estate deal like that, and it's 100% legit. Would you buy that house? Of course you would. Now, what if I told you that the government gave you a tax credit for a full $140,000 for buying that house? So, what I mean is you got the whole investment back on taxes and still get to keep the house. 80% of your money can be claimed back in year one, 20% over the following 5 years. Plus, the government also will put forward another tax break whereby the first 20% of all the rent is 100% tax-free. So if you made $5,000 per month, you'll only pay tax on the remaining $4,000. $1,000 completely tax-free. As an investor, does this interest you? Well, my friend, welcome to the world of buying oil fields in Texas for pennies on the dollar. The example I just explained to you is exactly how things play out when investing directly into oil wells. I'm not talking about big oil companies like Exxon, Shell, and Chevron. I'm talking about actually owning a piece of the producing oil field on a much smaller scale. At the end of this video, I'm going to give you an exact blueprint used to build an insanely profitable multi-million-dollar portfolio of oil wells across Texas. So make sure you watch to the end. Now, ask yourself, why invest in oil? Well, It's proven to produce long-term residual income. It's asset-backed, hassle-free, hands-off, with huge upside as it's set to boom again. So you can expect 30 to 40 years of income with tons of tax incentives. All you need to do is live in places like Dallas, Houston, Austin, and speak to millions of trust fund babies who've never needed to work a day in their life because of the long-term generational income oil produces. Here's what the experts have to say about what's happening in oil.
You must remember that the demand for oil continues to rise. It's not going down. The rig count globally, in the U.S. and globally, has gone down precipitously. This only means that the supply has got to diminish despite what's happening here in the Middle East, and the demand will continue to rise, maybe at 1 or 2% a year. And the combination of this means that we're going to see a higher price for oil going forward.
You think that we could trade through this $45 level? We seem to be in a bandwidth. $30 is what we're writing about, but you see us having the potential to break significantly above 45? How far?
We're looking, I'm looking at 60. I can't speak for everybody else in my company, but I'm looking at 60 as a target.
And this man is the former president of Shell Oil, John Hofmeister. And I think you're the guy who's got it right, because you're the guy who said the price of oil is going to keep on going up, maybe $60, $70 a barrel by the end of the year. Well, we're very close to $50 now. Take your victory lap, John, because I think you're right. Do you still say we're going to 60 or 70 by the end of the year?
Well, I think our wager is on the number of 80, which is still pretty bullish. But it's my guesstimate, Stuart, that sometime in the fall, it could be in October, November, the Russians and the Saudis have got to get a grip on reality that they cannot face 2017 with the same collapse in their budgets that they have had for the last 2 to 3 years. That they're going to have to do something, and the best thing for them to do, because they're so oil dependent, is to let the price of oil rise further by perhaps withholding 500,000 barrels each.
That there's going to be an OPEC emergency meeting. That should take it back to 45. This has been the pattern. So oil is breaking here based on actual inventories, and actually it's just the Saudis. And then it'll go back up because they don't want it down here because the Saudis need the money.
Earlier this year, when I spoke with legendary investor and chairman of BP Capital, Boone Pickens, the original wildcatter, he said he expected oil to rise significantly. Back then, I think it was about $30 a barrel, but he wasn't ready to set an end-of-year price. Let's see if we can get him to do that right now. Boone Pickens, just off the stage here at SALT. People are clamoring to talk to you right now. They're kind of waiting in line till you get off with me. Can I get you to give me a forecast for the end of the year right now?
What's going to happen to it?
Yes.
Well, you've shut down, Liz. We had an all-time high rig count of 1,609 rigs drilling for oil in the United States in November 14th. I said they'll go off 1,000 rigs real quick. Today, we have 342 rigs working. So 1,300 rigs have shut down.
Where's the price going to go?
The price going up.
How much?
Oh, you'll be 50, 60 by the end of the year. Could come sooner.
Real Money contributor Dan Dicker is here with his take on what we heard from the IEA this week about oil prices. Dan, this is the annual World Outlook report they put out, and the headline was that oil will get to $80 a barrel eventually. It's going to take a while.
Right, 2020, and in fact, I always look at the IEA predictions as much of a comedy show. They've had a horrible record when it comes to these projections. In fact, according to a projection 3 years ago, we're supposed to be at $110 crude today. So shows you how badly that they tend to get this stuff.
So what's a better guesstimate? Do we even know? I mean, if we look out to 2020.
Do we know? No, we don't know, but that's my job. I love making these kinds of predictions. In fact, that's how I make my living for 25 years, is predictions on oil prices. And my belief is that at some point, we're going to see the collapse in oil companies, the consolidation that's needed, and the drop in productions that's going to drive the next oil boom. In fact, I'm on the opposite side of the IEA, and I see prices that breach $150 a barrel by the end of 2017. Now that's quite a bit different from what the IEA is looking at.
That's huge from where we are now.
It is, and it's even harder for people to believe. I know that because when things are down, you never expect them to go back up. Just when things are up, you never expect them to go back down. This is something that will surprise, and in many ways, that's really the story for the next several years, is how much of a surprise that oil boom is going to be.
There's a few problems with investing in oil. Just like stocks, real estate, and any investment, there's risk. There are unscrupulous vendors, and there are downright con men when it comes to the world of investing, no matter what industry you're in. So you need to know who you're dealing with and who you can trust. When you know the industry and know what to look for, it's easy to navigate your way through, and in just a minute, I'll give you some tips that will firmly put you on the right track. You see, big oil companies make billions of dollars a year. Most people would tell you Apple is among the biggest companies globally. And while Apple is likely to be one of the most profitable, they only grossed $233 billion last year. In contrast, 8 oil companies individually made more than that. Most of them you've never heard of. Saudi Aramco, for example, made $478 billion, over double what Apple did. Sinopec made $455 billion, and even household company names you have heard of like BP, Shell, ExxonMobil, each made more than Apple's $233 billion. So, with all this money means they have huge budgets. So when they explore for oil and hit a dry hole, they easily swallow the loss. Yet the cost of exploratory drilling program, coupled with huge overheads like skyscraper buildings, private jets, 100,000 plus employees, 401ks, retirement plans, and so forth, means the profit these oil companies make is relatively small to what they gross, especially when the price of oil is low like today. So investing with them yields a pretty average, unexciting dividend. Plus, when investing in big oil, you get zero tax breaks with no real major upside, as those companies, already have grown to maturity. Investing in smaller producing oil companies is a lot more exciting, but also deemed more risky. Another issue is they're not as easy to find. They don't all have huge marketing dollars like BP and Chevron to let you know who they are, which is why you likely haven't invested into oil before. The big boys are not exciting enough, and you probably don't know any of the smaller players. A huge issue to consider with smaller companies is they do not have the budget of the big boys. So if they explore for oil and hit a dry hole, in a lot of cases, they go broke or barely survive, and your return is worse, and you suffer less than exciting big oil options. So what I want to cover now is how you can safely invest into oil with smaller companies that mitigate the loss or risk to protect the downside and accentuate the upside. After all, when investing, the most important part is low to no risk. You want safety, and then right after, you want huge returns. The mythical investing scenario, right? Low risk, high returns. It's possible, but it's hard to find. Here's how our company and investment strategy works to making consistent returns in the oil business with very little risk. We use a technique called offset drilling. When our chief geologist, Russell Montgomery, was a hired gun for big oil companies, he slowly started to develop this technique for the big boys to help them eliminate the risk in exploratory oil. After a number of years of doing this and making big companies billions, Russ went out on his own. Not having billions in the bank, Russ has developed his method for smaller oil plays that big oil has no interest in. Big oil wants oil fields that produce 50,000 barrels of oil a day or more. Russ and his team are looking for oil fields that produce 1,000 barrels of oil a day. Might seem small, but 1,000 barrels of oil, even at low prices, like $55 a barrel, is still $20 million a year. Now, here's a quick video of Russ explaining how his method works.
What we do is developmental drilling only. We do not explore like big oil. And also, exploration costs a lot of money, and there's a lot of losses in exploration. We don't do that. At Unjoined Cubed, all we do is develop known reservoirs.
And the new technologies, this horizontal drilling, this is areas that still have pools and pools of oil. They could go back in there and horizontally drill for oil. Am I correct about that, sir?
It's called enhanced oil recovery. Absolutely. You can repressurize the well. Probably 2/3 of the oil is still there. You could recover a whole lot of more oil, and we could be less dependent on imports from other parts of the world.
Or, John, we could go ahead and drill further. We can drill Anwar and have, I don't know, 50 or 60 years of oil. We could drill further out in the continental shelf. What's wrong with those ideas?
There's absolutely more oil in this country than we will ever need.
As you can see by the geology that we have here, and we've spoke about earlier, we take our history, our geology, and our science and apply it to known existing locations. These blue dots are old wells. And what we do is we're able to have geology that correlates across angles from one to the next. And what we do is we have multiple points of known data. And as we take those multiple points of known data, you'll notice the well bores cross these exact known areas. We're developing the interior field sections that were never touched during exploratory drilling programs 40, 50, 60 years ago.
I want to quickly talk about how we protect the downside. Sure, the offset drilling method certainly helps to mitigate risk, and in the last 5 years, using his method, Russ has never hit a dry hole. But there is a lot more to consider here. Running costs, for example. Big Oil makes billions, way more than Apple. Yet Apple's profitable, much more so. So for Big Oil to profit heavily, they want the price of oil to be high. We believe that you need to be able to profit heavily in low oil prices. And when it does spike back to its 10-year average of $80 a barrel, we can make obscene profits. So how do we do it? Well, when you look at all the running costs and huge unnecessary overheads of US-based big oil companies and break it down, it ends up costing roughly $30 to pull a barrel of oil from the ground. So when the price of oil is anything above $30 a barrel, Big Oil gets rich, which is why the lowest oil has been on record when adjusted for inflation is exactly $25.55. Big Oil won't let the price of oil drop below that. Try to imagine what would happen if Big Oil went bankrupt and had to stop producing oil. Gas stations would be empty in days. Transportation would grind to a halt, leaving grocery stores barren. No one could go to work. The entire planet, as we know it, would cease to exist. It would be a worldwide disaster, greater than anything on record, 100 times worse than the Great Depression of 1929. So, it's fairly unlikely that oil will ever go below $30 a barrel for any significant amount of time. Saudis, however, can profit at even a lower oil price because their running costs are roughly $13 a barrel. However, they still have huge overhead, massive expense accounts, and large-scale exploratory drilling programs, so the number of $13 a barrel pulling cost could be a lot lower if it really needed to be. The reality is, if you keep things small, low-tech, don't go for 50,000 barrels of oil a day, avoid high-expense living with corporate jets, 100,000-plus employees, huge salaries, enormous benefit programs, and retirement plans, as well as all the unnecessary expenses, you can pull oil from the ground for as little as $3 a barrel. All you really need in a low-tech environment is 2 petromechanics, 2 pickup trucks to monitor the ongoing operation functions of the well, pay the electricity bill to move the motor to allow the jack to do its thing, and keep the oil flowing along with a good accountant to make sure all the books are in order so investors and partners get paid on time. Outside of that, we have a very strong management team that oversees all our projects. Less than 10 on staff to manage these multiple projects that are ongoing. Our equipment, well, it's not pretty. However, it's all treated with non-corrosive paints to last the harsh weather conditions. We don't waste money mowing the grass or trying to give oil field curb appeal. We want to keep all running costs to an absolute minimum, which increases our profits. When it comes to equipment malfunctions, well, the types of pump jacks that we use rarely break down, maybe once every 4 to 5 years. The replacement cost of the part is approximately $4,000. These wells pull at least 20 barrels of oil a day, so even at the lowest oil's ever been on record, 25.55, when adjusted for inflation, these wells profit. How? Well, like I said before, our running cost to get the oil from the ground is roughly $3 per barrel. Now, another expense that we have is to get the oil hauled away and sold. For that, we pay $2 per barrel to our partners, Royal Dutch Shell. They drive the oil truck out to our property every 12 hours, load the big oil tanker with whatever we produce for that day from our oil wells. The exact amount of oil we give them is captured in a similar way as you see at a gas pump in your local gas station. Shell will then take it to the refinery where they refine it into gasoline and make huge profit by selling it to all their other global gas stations. So after we deduct the $3 running cost per barrel and the $2 cost per barrel to get the oil sold, let's say we're left with roughly $20 a barrel pure profit. If all oil falls to the lowest possible scenario in history, a well will generally pump more than 20 barrels of oil per day. But if we only pump 20 barrels per day per well, each well will make 400 a day, which is 146,000 per year, and profit after all the expenses. The well will break down an average of once every 5 years, cost roughly $4,000, like I said before. So the worst a well will make us is roughly $730,000 after 5 years. All the running costs at most will cost us a further 4,000 parts and labor. This, remember, is the worst case scenario if the oil drops to the lowest price ever recorded with the wells underperforms at 20 barrels a day. That's why we call this the greatest real estate deal in history. It's asset-backed, long-term, low-risk, hands-off, hassle-free. We currently have a project in operation that consists of 8 phases, 20 producing wells with 42 new wells to be drilled. We're now into phase 2 of the project as this video is currently being made. Phase 1 was a massive success. We had over 20 investors participate from all over the globe, and as you can see, some of the snippets of the building under work while we undertook the project. Each phase has slightly higher entry points due to new infrastructure costs. The current project already has over $2 million worth of pipeline, storage tanks, and roads in place. We also offer our own water treatment facility right on site to allow us to safely treat water, pump it back into the ground to force more oil up to the surface. This drastically reduces overhead as the majority of the other small players need to haul water away to have it environmentally disposed of. It's a huge expense, and without it, can wipe out a ton of profit from oil in one single day. Our water treatment facility actually turns our wastewater into a profit center. A full unit of phase 2 of this development is $140,000 US. We have investors who buy multiple units and some who want to dip their toe in the water and invest a quarter of a unit, which is only $35,000. So you can invest a small or large amount depending on your comfort factor. What some investors do is to come to Texas, meet with us, greet with us. They visit the oil field and learn in depth what we do. Our investor tours begin by being collected by the president of our company. We then take you through the whole process, and afterwards, you can make an educated decision on whether you want to be involved. It is that simple. If any of this sounds of interest, give us a call right away. Our number is 512-357-3330 to see what phase we have available. We'll put you directly in touch with one of our investor relation department experts, and we can see if it's a fit for both parties.